Welcome to the first episode of Making Risk Flow. I am your host, Juan Di Castro, Chief Operating Officer at Cytora, where I lead product engineering and client relationships. I previously served as Chief Operating Officer at Hiscox UK and as a Senior Manager at McKinsey's Silicon Valley office. I specialize in driving intelligent growth and operational efficiency through digital transformations and innovation. In this podcast, we will talk about how to drive successful transformations in insurance to drive higher performance through improved efficiency and risk selection. And we will do it through sharing my own views, but also through discussions with the change makers in the top insurers globally. I hope this podcast serves as a forum for like-minded people to share ideas and learn from each other. We all want to make the insurance industry a sector that delivers better value to our customers through more efficient transfer of risk. And this is because the insurance industry is at the heart of a thriving economy. If insurance is manual and inefficient, insurers can only scale sensibly by adding more humans. This is, more humans equals more expense. It deters insurers from taking on new kinds of risk. And then individuals and companies are left holding more risk, so they take fewer chances, which slows innovation and more broadly progress in society. On the other side, if we can build an efficient industry, insurers will be able to take more risks and offer more affordable products. More risk will get covered across all society. Businesses and individuals will be more inclined to take risks, to build, innovate, and expand. Let me start this episode with a historical analogy. How other industries' work has changed over the last couple of centuries. We can learn so much from how other industries have evolved throughout history, and some analogies will make it easier to tackle the principles of digitization in insurance. And bear with me, it will all make sense in a minute. Let's go back a few centuries. The Industrial Revolution was the transition to new manufacturing processes in the late 18th century. Instead of items being produced by hands, processes were invented which allowed items to be produced by machines. And three key critical innovation breakthroughs enabled this revolution. The first breakthrough was new tools. New chemical manufacturing and iron production processes were invented. Before the Industrial Revolution, millwrights built windmills, carpenters made wooden framing, and smiths and turners made metal parts. As the Industrial Revolution progressed, machines with metal parts and frames became more common, overcoming the challenges of wooden components, changing dimensions with temperature and humidity, and the various joints tending to work loose over time. The second breakthrough was new forms of fuel. The main acceleration of production was the use of steam power. During the early period of the Industrial Revolution, most industrial power was supplied by water and wind, which delivered significantly less power. And the third breakthrough was automation. Production methods evolved from hand production to machines, with the rise of the mechanized factory system. In a minute, you will understand how these can be identified. So new tools, new fuel, and automation in today's insurance world. The impact of the Industrial Revolution was clear. It began in Great Britain, and by the end of the 18th century, Britain was the world's leading commercial nation. The second major shift in manufacturing was the introduction of the assembly line. The assembly line was first patented in 1901 by Ransom Old, a car manufacturer. The assembly line allowed his company to increase their output by 500% in 1 year. Because they were creating more vehicles, this allowed them to drastically decrease their prices. Ford then improved on old system by using moving platforms and a conveyor system. The vehicles were towed by a rope which would move them from station to station. This way, Workers could just assemble the different pieces as they arrived at their stations. The impact of the assembly line was also obvious to the customers. Previously, cars were considered a luxury item, but as production efficiency increased, they were able to drop prices drastically so that the vehicles were more affordable. The third major shift was lean manufacturing, developed in 1948 by Toyota. This process was developed in order to improve the flow of production by identifying and eliminating waste. The key concept of lean manufacturing was to ensure that every single activity in the production line added value to the end customer. Everything else was removed to streamline the process. This system was mostly confined to Japan until the 1970s, when the United Kingdom began to adopt their own system of lean manufacturing. By the 1990s, the concept of lean manufacturing began to spread outside of the automobile industry. It's now used in electronics, aerospace, healthcare, construction, and even food manufacturing. There are two key characteristics in lean manufacturing I want to mention. The first one is the concept of flow. Flow is a lean method that allows you to move a single product through every step of your process instead of grouping work items into batches. The method is called this way because it allows you to send goods to the market continuously. You can start getting the idea of how this applies to insurance. For example, when trying to reduce the turnaround time to get back to the client or broker with a quote for a given risk. The second lean manufacturing concept is removing waste. This is tweaking the production process to create quality products efficiently through the complete elimination of waste, inconsistencies, and unreasonable requirements on the production line. Some examples of waste include excess processing, which is found when there are activities that don't bring additional value, or unused talent, which is found when there is an underutilization of employees' skills, or transportation, which is found when the item of work is moved from one station to another without adding value. You'll see later how this applies to insurance. To summarize, we've talked about three main evolutions in manufacturing. First, the Industrial Revolution and how it was enabled by three key breakthroughs: new fuel, new tools, and automation. Secondly, the concept of assembly line, moving items of work along the factory to streamline production. And thirdly, lean manufacturing concepts of flow and waste, ensuring that every single activity in the production line adds value to the end customer. These three evolutions completely transformed the manufacturing industry, delivering an order of magnitude greater efficiency, effectiveness, and throughput, and resulting in more affordable products to customers. So why is all this relevant to insurance? There are actually many analogies between these three evolutions in manufacturing and the current state of the insurance industry. Today in insurance, we see similar dynamics than those that you could see in a factory before the Industrial Revolution. You can see highly manual processes, items of work which are risks that need to be individually processed, or a number of activities that do not drive value to the client. We also see plenty of waste in insurance processes, similar to the 7 sources of waste in lean manufacturing. To pick a few, we can see excess processing when underwriters touch too many renewals that do not need to be re-underwritten. We also see unused talent when underwriters are spending hours a day copy and pasting data from different systems. Or we can see transportation when risks bounce from one underwriter to another to find the right skill match. These cumbersome operations are preventing insurers from setting up processes where risks flow without any waste. And all of these results in similar challenges to those early in the manufacturing days: inefficiencies, long lead times, repetitive work, and frustration. And ultimately, these challenges impact the ability of the insurance industry to serve their customers efficiently and timely. So following the lean principles, intervention should only happen where required and where it can add value. Applying the analogy of the conveyor belt to insurance, the movement of the risk should happen automatically and independently, moving the risk to the consecutive decision point and only stopping where and when a human intervention is needed to add value. So why has insurance not progressed quicker? The main difference in insurance is that the raw material is intangible. The item of work, the risk, is intangible. The tools to process risk, the data, is also intangible. So to deliver a real transformation in insurance, we need to design data flows that enable risks to flow throughout the industry, just like the manufacturing industry did a century ago. So really, what we call now digitization is no more than driving an industrial revolution in an industry that is based on data rather than on tangible materials and physical manufacturing lines. This reliance on data has prevented the industry from evolving as the breakthroughs required just were not present, until now. Today we've got available these technology breakthroughs that are similar ingredients to the ones that drove the revolutions in manufacturing. First of all, we have a new fuel in the form of much richer data about risks. Today we have tenfold more risk data available from external sources than what was available 5 or 10 years ago, when all we had was a broker form. We have geospatial data for property risk. We have historical financial data about companies. We have social data about how a company is perceived by their customers. Data is actually available at our fingertips if we can make good use of it. We also have new tools in the form of artificial intelligence, machine learning, or OCR. This is key to enable this evolution, as the wealth of data is useless unless it can be automatically processed by machines. With tenfold more data about the risk, we cannot expect humans to be able to absorb and identify relationships across all that data. We also have new automation capabilities in the form of large processing capacity. With the cloud, our ability to immediately expand our processing power is unheard of. So these three breakthroughs are at insurers' disposal to reimagine the way they operate. But how do we start making progress? In this podcast, we will dissect how these breakthroughs can be specifically leveraged to drive a more efficient, effective, and trusted insurance industry, just like our colleagues did in manufacturing a century ago. In the next episodes, we will discuss how these ingredients enable specific use cases and processes. We will split down the daunting concept of insurance digitization into chewable chunks that make sense and drive immediate benefit to insurers and end customers. Some topics we will touch on are, for example, how we can streamline the new business submission workflow, removing waste, such as underwriters working on out-of-appetite submissions or doing manual work, and enable underwriters to write the business they want by automatically creating decision-ready risks and prioritizing broker submissions that fit their appetite. We will also, for example, discuss how we can streamline the renewals workflow, automatically identifying which clients have changed in the last period, either because of a change in the rating factors or in claims activity, and only touching those renewals that require re-underwriting. We will also discuss how we can streamline pre-underwriting activities such as risk clearance by automatically resolving the end customer to a unique identifier and automatically checking any existing exposure in the current book. We will also discuss how we can streamline book transfers, automatically analyzing whole portfolios through the use of external data, enabling insurers to pre-quote them and driving portfolio underwriting. We will also discuss how we can drive effective proactive pipelining by automatically identifying clients that fit with each insurer's underwriting strategy. So if you're a commercial insurer and are looking at increasing operational effectiveness, driving profitable growth, transforming your organization through incremental improvements, and bring the team along the transformation journey, this podcast is for you. I'll see you in the next episode of Making Risk Flow.